What is the price-to-sales ratio? Have you ever wondered how investors determine the value of a company based on its sales? One important metric they use is the price-to-sales ratio. This ratio compares a company's market value to its total sales or revenue over a recent period, usually the last 12 months. It helps investors see how much they are willing to pay for each dollar of sales generated by the company. To calculate the price-to-sales ratio, you divide the company's market capitalization, which is the total value of all outstanding shares, by its total sales or revenue. Alternatively, you can divide the current share price by the sales per share. This gives you a clear number that reflects the relationship between sales and market value. Why is this ratio useful? Well, sales figures tend to be more stable than earnings, which can vary due to accounting practices. A higher price-to-sales ratio often indicates that investors expect higher growth or better profit margins in the future. On the other hand, a lower ratio might suggest that the stock is undervalued or that the company is facing some challenges. For banks and credit unions, understanding the price-to-sales ratio is essential when evaluating potential investments or assessing the financial health of companies they may lend to. Since these institutions focus on stable cash flow and sound financial fundamentals, the price-to-sales ratio provides a straightforward way to compare companies' market valuations relative to their sales performance. It can help identify companies that may be overvalued or undervalued based on their revenue generation. In the realm of value investing, where the goal is to buy securities trading for less than their intrinsic value, the price-to-sales ratio is a key part of the checklist. Investors can use this ratio along with other financial metrics to minimize investment or credit risk. By favoring companies with strong sales relative to their market value, banks and credit unions can make more informed lending or investment decisions. In essence, the price-to-sales ratio is a simple yet effective tool for gauging how the market values a company's sales. It provides insight into investment potential and financial stability, which is especially relevant for banks and credit unions looking to make sound financial choices.